Welcome to this IFRS update. It's a virtual session this year, and it's also including some corporate elements. My name is Bjarne Jørgensen, and I'm heading the Accounting and Reporting Advisory in Deloitte and a partner of Tyble. The full session today will be in English, but of course you are more than welcome to ask your questions during the session in Danish. Regarding the questions, we won't answer them during the session, but at the end of the session. We have a couple of minutes answering questions there. We can also see who of you have actually asked the question. So be absolutely sure if we don't answer your question at the end of the session, we will answer it directly to you by email afterwards. We will also have some polls during the session where we will use mentimedia.com, but much more on that one. I know some of you have an education called State Authorized Public Accountant, and this session will give you 1 hour of credit points related to that education. Simply follow the instructions on the screen here. And talking about the slides, we will send out the slides to you afterwards, so you don't need to take any pictures or notes for your own. You will have the full slide deck sent to you afterwards. Also, of course, including these instructions for getting any credit points. Turning to today's agenda. We will start out having an IFRS 16 session. That IFRS 16 session covers our view on processes, our view on solutions so far, and Thomas Jølund will take you through that. Then we will turn the picture onto the new practical expedient about rent concession and related to IFRS 16 as well. And Henrik Gustafsson is the man to take you through that session as well. Henrik will also start talking about what's new for 2020 and the years to come. And when we then enter the scene for the new general presentation standard, so the exposure draft to the US 1, Søren Nielsen will enter the stage and take you through the details in that standard. Henrik Grønnegaard will then enter the stage talking about the new ESEF requirements, so the new requirements for electronic filing of your financial statements if you are a listed entity. After Henrik have talked about that, Martin Forborg will enter the stage and talk you through some climate elements related to financial statements. Martin will also cover the new corporate governance guidelines and the requirements related to remuneration reports. Then I will enter the stage again, talking through the IFRS in focus. And for this year, we have chosen COVID-19, big surprise there, and talking through a few elements where we see some impacts of COVID-19 in the financial statements. We will end the session having Jan Peter giving you the highlights of the trends that we see related to the financial statements, both from a Danish perspective, but also from a global perspective. And then, as introduced to start with, we will end with a question session and a round off. Please enjoy, and I'll give the word to Thomas.
Thanks, Bjarne. I'll start by sharing some takeaway from our experience with supporting companies with their implementation of IFRS 16 and our first year of auditing the IFRS 16 numbers. Then my colleague Henrik Gustafsson will present the latest amendment to the standard. For most companies, the main focus the first year was to get the data collected and validated, calculating the impact on the accounting numbers and communicating the impact to the key stakeholders. As a natural part of this process, organization also looked at a system to support the ongoing data updating and the financial reporting. The large companies with a large number of leases went with a dedicated lease system, whereas most of the other companies choose a more temporary solution, which means often a Excel-based solution due to the price level of the dedicated systems at that time. What we have also seen is that most companies have not been that successful in making the necessary change to the underlying processes. Meaning that every update of the IFRS 16 numbers feels a bit like implementation all over again, with a big workload and sometimes even a delay in the reporting. A key symptom of this is that there is an increased difference between the expected lease payment in the system and the actual lease payment from the external vendors, indicating incomplete data or error in the data. When looking at the process, the necessary change depends a lot on the size and complexity of your organization. No matter if you're mid-size or large companies, you will need to look at more than just the lease process itself. If you're mid-sized companies, it have mostly been enough to look at implementing a Excel-based system, tweaking the lease payment process, and implementation of a few controls in the close process. Whereas for larger organization, they have also looked at aligning the policies, could be the limit for small tickets, organization structure, i.e. do we need to have a centralized or decentralized data ownership, and the service delivery model, typically the split between asset management and finance, in order to be successful in having a lease accounting process that on an effective way support preparing of a financial statement. So in order to better understand how organizations have designed their lease accounting process, we have sent out a process-focused survey to a number of our advisory and audit clients. And based on this survey, it can be concluded that many companies have prepared flowcharts, activity descriptions, and a risk and control matrix to support and to make sure that the involved people all understand the process and their role in it. We can also see there's no clear answer on how to design the process, but there's a bit more companies who lean towards having a separate process and a centralized team that is in charge of that process. It's a 50-50 split between pushing the IFRS 16 numbers to the ERP system or just having a consolidated adjustment. My personal view is that more companies will push it down to the ERP system to ensure one set of numbers. One of the key controls that we have seen companies implement is a reconciliation between the lease payments. And we have also asked the companies, so how frequent do you do these reconciliations? And most companies lean that it's a quarterly control, but some, depending on the size of contracts, do it yearly and others do it monthly. The risk and control matrix that we have seen have typically identified risk in the lease system, in the ERP system, and even some with the external vendors, if they have, for instance, rent agreements with smaller vendors. In the lease system, risk for errors could be that they were entered incorrectly and not identified, or even that contracts are not identified. Could also be that a non-standard lease contract were entered as a standard, that you will then generate numbers with errors. In the ERP system, it could be that you have designed a process where you book small tickets on a separate G&L account, but that was entered into a wrong or a different GL account. So currently, what we're seeing based on what I have just described about the process is that even the mid-sized companies are looking to replace their interim solution with a system. The reason why they are looking into this is that the cost of the system has decreased, whereas the cost of running a temporary solution have decreased. So the cost-benefit solution or the tipping point is different now than it were at a later point. But if you look at other benefits than just the cost benefits, it could also be that the data quality would increase if you have a lease accounting system. You can also use it a bit as a contract management system, so it is easier to update if there is an option that you need to extend, that put it in the system. You can use the system to support that you make sure that all the options you identified and put into the system, what you decide to do with it. But also the reporting part, generating the journals, is a lot easier if you have one centralized system than if you have an Excel-based solution. So at Deloitte, we have contract with a lot of different vendors that support the lease accounting process, and we know a lot of these and understand what they're good at and their areas of improvement. On this slide, we just summarize some of the key players in the Nordic market and some of their references. All of these different systems have different things they're really good at, different strengths, different way for the users to come to their conclusion what they need to do, and also, as I mentioned, areas of improvement. Beside the different use, it's also they have different price structure depending on your business structure, depending on the number of contracts, depending on the number of users. But what I can say is that prices for the system will start in the range of a few $100,000 DKK a year and running up to in the range of 1 million. So before you go into selecting a system, you can reach out to us and we can definitely support you on your journey with a different support. And Henrik, I'll give the word to you.
Thank you, Thomas. Before we move on to talk about the amendments to IFRS 16, we have a small poll for you. Bjarne, would you like to introduce the polls?
Absolutely, Henrik. So the instruction is actually on your screen right now. So you should grab your phone, go to your Explorer, so normally Safari, and go into menti.com. And then we have a code here that you should enter on the top of the screen. It's 8424886. And the question is about what solution are you actually currently using? And people are started voting here. We have already a couple of votes coming in, but the question is about, are you having a software solution right now? Are you having what we call a home-built Excel spreadsheet, so with your own Excel expertise? Are you having an Excel spreadsheet bought from a provider? Could be ours Excel spreadsheet, Henrik, if you are so lucky. And are there any other solution you are using that doesn't cover these three items? And Henrik, polls are coming in.
Indeed, fairly spread among the first three solutions. I guess that was also our impression, pretty much what we were expecting to see.
Majority is in the home-built Excel spreadsheet. I guess that is not that surprising, but as Thomas said in his presentation, the prices on the software solutions available out there are being lower and I would say more acceptable for mid-market clients as well. So our impression is that we will see an increase in the software solutions going forward. Yeah. So home-built Excel spreadsheet win this poll for now.
Yeah. Good to
Will
see.
you go take it further, Henrik?
We have another poll for you. The next question is about how satisfied are you actually then with your current process? So are you satisfied with the solution you have chosen? Are you satisfied but there are minor adjustments or improvements required? Or are you not satisfied with the current solution and therefore you will probably have to look for another solution? And then finally, you currently do not have any IFRS 16 processes in place. So those are the questions, and there's already a number of answers coming in.
And again, referring back to what Thomas just said, is that we see that companies, at least our impression is that we see that companies has focused on the implementation of IFRS 16, and that has been so tough a task. So you have maybe not focused on implementing processes around the IFRS 16 accounting procedures. But what we see here is that you guys in general are satisfied, but accepting that minor improvements is required. A few of you, or not a few, but 24% say you are not satisfied indeed.
I think actually a number of entities went for a quick fix solution and went with a fairly simple Excel spreadsheet to do the accounting, and they are now beginning, as I guess Thomas also mentioned, to see that Excel has its limitations, particularly when we are beginning to having changes to the lease contracts. So that's what we at least have seen.
Yeah.
Okay. Good.
Thank you.
With that, I think we will move on to talk about the amendment to IFRS 16 that was issued in May this year. So, since the outbreak of the COVID-19, we have seen around the world numerous examples of lessees being granted rent concessions from the source to mitigate some of the negative economic consequences of the pandemic. And this has raised the question as to whether such concessions are modifications in accordance with IFRS 16. And the accounting is rather different depending on whether or not they are in fact modifications. So if it's something, these rent concessions that the lessee would be entitled to already under the current contractual terms, for instance, because it was within the requirements or the terms of force majeure, or if it was something that the local law would say that the lessee was entitled to, then it would not be a modification. And in that case, generally, lessees would treat these rent concessions as negative variable lease payments. If, however, that was not the case, it would be a modification, and then IFRS 16 would require the lessees to remeasure the lease liability using an updated discount rate and then recognize any consequential adjustments to the lease liability also in the right of use assets. The ISB acknowledged that this could potentially be quite burdensome for lessees, both to do the assessment of whether or not it was a modification, and if it was a modification, to actually having to remeasure potentially a very large portfolio of lease contracts. And that's why they issued the amendment to IFRS 16. With that amendment, they provide the lessees with a practical expedient. It's for a limited time period, but they provide this practical expedient in which the lessees are allowed to say that these rent concessions are not modifications and therefore treat them as variable lease payments. However, there are some conditions attached to it. First of all, the rent concession must be a direct consequence of the COVID-19. And secondly, the total payments on the lease must be reduced or at least stay the same. And when we say stay the same, it could, for instance, be that the lease payments for the, say, forthcoming 3 months are reduced, but then at a later date in the lease contract, under the terms of the contract, the lease payments are then increased by the same amount, or even by an amount also taking into consideration the time value of money. That would still be okay, and that would still be within the amendment and this practical expedient. Another condition is that the rent concessions do only relate to lease payments that are due before 30th of June 2021. So we cannot provide rent concessions beyond that date. And then the final condition is that there are no other changes to the contractual terms of the lease contract. And this, for instance, means that if we are today granting rent concessions for a full 12-month period from today, then we are exceeding that date of the 30th June 2021, and then we cannot apply this practical expedient to either of the rent concessions, not even those that are actually due before that date. If we do apply this practical expedient, there are also a few additional disclosure requirements. So entities would have to disclose that they have in fact applied the amendment, and also they would have to disclose the amount that they have recognized in profit and loss as a consequence of applying the amendment. The accounting treatment differs slightly depending on whether the rent concessions are a full forgiveness of the lease payment or if it's merely a postponement of the lease payments. So if it is a forgiveness, entities or lessees would recognize the rent payments being forgiven as a negative variable lease payments in profit and loss, and they would de-recognize the part of the lease liability that had been forgiven. If it's merely a postponement of lease payments, so lease payments on later dates are increased by the same amount, well, really then there is nothing to recognize here and now because you haven't received any changes in the total lease payments. You would still, as a lessee, have to recognize interest costs, and you would then de-recognize part of the lease liability as and when you actually do make payments to the lessor. If you have not taken the time value of money into consideration when you at a later date increase the lease payments, there would be, however, an amount to recognize upfront, simply because the present value of the lease liability have changed. But you remeasure the lease liability using the original discount rate, so you don't have to go out and find a new discount rate. And the consequences will be recognized in profit and loss. There is also a third option, so it could be a combination of the two previous options. So there is both a real forgiveness and then part of the rent concession only is then added to subsequent lease payments. And when that's the case, you start by applying what I just said to the actual forgiveness, and then move on to just remeasure the lease liability for the postponement part, unless you have taken time value of money into consideration there. The amendment is effective for financial periods beginning on or after 1st of June 2020, but early adoption is also allowed, and that also includes interim financial statements. The amendment says that it must be applied retrospectively, and for most entities that will apply the amendment and the practical expedient in 2020, if you have a calendar year financial period, it won't actually mean anything because in 2019 we didn't have COVID-19, so there wouldn't be any retrospective effect. But if you do not early adopt in 2020 and you want to use the amendment and the practical expedient in 2021, there could potentially be an effect for 2020 that you would then have to take into consideration as well. And if that's the case, that effect will be recognized in the opening balance in the year in which you first apply the amendment, so 1st of January 2021, for instance. Luckily, we do not have to comply with IAS 8 requirements on change in accounting policy. This is essentially introducing a new accounting policy and applying a new IFRS rule. And IAS 8 would normally require us to disclose the effect for each line item in the financial statements being affected, but that's not required in this case. The amendment was endorsed by EU on the 9th of October, so it is ready for use within EU as of now also. And therefore it would also be able to, you would be able to apply it also in your 2020 financial statements. Everything I've said about the amendment relates only to lessee. So there are no changes, there are no practical expedients for lessor. So lessor would still have to assess whether these rent concessions are modifications to lease contracts or not, and then treat them accordingly. And with that, we actually have another poll for you. This time, the question we would like you to answer is whether you expect that you will be applying the practical expedient. And actually, very interested and looking forward to see the results coming in. What we have seen in Denmark is that we haven't really seen that many rent concessions being granted in Denmark, possibly because some entities would be able to include it in some of the governmental aid packages. However, as I said, worldwide there are a lot of these rent concessions being granted, and therefore if you have foreign entities, it could potentially be relevant nonetheless to apply the amendment. And I can see that at least some of you already now know that you will be applying the amendment, and around half of you already now know that you will not, probably because you haven't really received any of these rent concessions. And then there is a fairly big amount of you there that's still undecided. Or maybe you could potentially get rent concessions from now on and until 30th of June. Good. I think, but actually this is pretty much the same picture as we saw when we did the last session and when we did a poll. So thank you very much for that. And now moving on to what you have to implement in your financial statements for 2020. And we will not be spending much time on this because really there isn't that many changes that you have to implement in your financial statements for 2020. And those changes that are is minor clarifications basically, or in one case it's you are granted a practical expedience. So if we start at the top left corner, the amendments to a number of standards is from the conceptual framework is only replacing the reference to the old ISB framework with the new references to a new framework that was issued by the ISB in March 2018. So, and the ISB have themselves said that they don't expect there to be any changes in the financial statements and accounting policies from this. The second one is the definition of a business within IFRS 3. This is the result of the post-implementation review that the ISB did on IFRS 3. And some of the comments they received was that the definition of a business was sometimes difficult to understand and apply. And this definition is, of course, important because it determines whether it is a business combination within the scope of IFRS 3 that you have, or whether it is an asset deal. And the accounting is quite different between the two. And in my opinion, the actual change of the definition is not expected to result in significant changes to what you do today. They did, however, also introduce a practical expedient, so a concentration test, whereby the entities, the acquirers, are allowed to have a look at the gross fair value of the assets acquired, and if that is related to a single identifiable assets or a group of identical assets, then the acquirer is allowed to say that it is not a business combination, that it is simply an asset deal. So that's the most important change, I believe, from this project. And the next one, amendments to IAS 8 and IAS 1, and also IAS 10 and a few other standards, is the clarification of the definition of what is material. The ISB found that there wasn't complete consensus amongst the definitions within the standards and within the practice statement they have issued on materiality. So this is actually aligning the definition of materiality. They have also within the definition now included obscuring, so information is also material if obscuring it would change the decisions that users of the financial statements make. And then they have provided a couple of examples of what obscuring would be. One of them would be that the information is presented in such a vague language that you actually do not explain and provide the relevant and necessary information to the users of the financial statements. Another example would be that the information relating to a transaction or an item is spread throughout the entire financial statements rather than having all the relevant and necessary information presented in one single note. And the final amendment that you have to consider in your 2020 financial statement is the amendments to IFRS 9, IAS 39 and IFRS 7 related to the IBOR reform. The ISB split their project on the IBOR reform and the consequences for accounting from that in two phases. And in this phase 1, which is effective for 2020, they deal only with the effects on hedge accounting and only before the reference rates are actually replaced. The IBORs are replaced by an alternative reference rate. And basically what the amendment says is that entities should not discontinue their hedge accounting simply because a reference rate in either the hedge risk or the hedging instrument is in the future going to be replaced by an alternative benchmark rate. There are additional disclosure requirements, so if this is relevant to you, you have to disclose the exposure you have to these IBORs, the ones that are most significant to you, and also the progress you have made in terms of replacing these IBORs with alternative reference rates. And then in 2021, the phase 2 of this ISB IBOR project is effective from 1st of January. And in this phase 2, the ISB deals with the effects of the IBOR reform once the benchmark rates have actually been replaced. And again, it is practical expedience for a limited period of time. And again, when we're talking about hedging, the outcome of this amendment is that you do not discontinue your hedge accounting simply because you have changed the reference rate to an alternative benchmark rate. In this phase 2, they also consider the effects on various loan arrangement debt instruments that have a reference rate linked to an IBOR. And basically, the outcome of the amendment here is that the interest will be calculated based on the new alternative benchmark rates as from the date it is changed and onwards. And in most cases, there wouldn't be anything to recognize at day one. The other amendments for effective for 2022 and 2023, we will not go through those. They are also minor amendments if we look apart from IFRS 17, and they are not effective for neither this year nor the forthcoming year. So with that, I will hand over to Søren, who will take you to the exposure draft on general presentation and disclosure.
Henrik, and I'm going to talk about an exposure draft for a new accounting standard. In December 2019, ISB published an exposure draft for a new standard about general presentation and disclosure requirements. This proposal is a part of a larger project on the ISB agenda on improving financial reporting. This standard will replace the current IS number 1. A lot of the provision in IS 1 will just be transferred to the new standard unchanged, but in certain areas we'll see some changes. This especially deal with the income statement, the presentation of the income statement, and then some new disclosure requirements will be introduced. There was a deadline for comments on the end of September. ISB has not proposed any effective date yet, but it's promised that it will not be effective sooner than 18 to 24 months after the approval of the standard. But let's start with the income statement. First of all, the proposal suggests the income statement to be divided into 3 categories: operating category, investing category, and financing category. And this is something we have seen before, because in the cash flow statement you have also 3 activities. You have operating, investing, and financing activities. But the content is not exactly the same. For instance, in respect of acquisition of property, plant, and equipment, in the cash flow statement this will be included in the investing activities, but in the income statement it will be the depreciation of these items will be presented within operating activities. The new standard also introduced 3 new mandatory subtotals in the income statement. The first one is result of operating activities, and the next one is result of operating activities and income and expenses from what they call integrated associates and joint ventures. And that means for the future we need to divide our associates and our joint ventures into those that are integrated to the operation of the investor and those that are not integrated. And the ones that are not integrated should be presented within investing activities. And the last subtotal is profit before financing activities and tax. The new standard actually removes some of the choices you have in IS1. And one of these is presentation of expenses. As of today, expenses has either to be presented as by their nature or by their function. But today you can present that within the footnotes. For the future, this presentation needs to be in the face of the income statement. Another new introduction is presentation of foreign exchange gains on losses. This has to be allocated to the same category as the income or the expenses that gave rise to these FX gains or losses. Today, quite many entities will present that within financing activities. I guess there's a few already have this divided into the categories, but it will be mandatory for the future. And in respect of result of hedge, it has also to be allocated to the category that is impacted by the risk that has been hedged. And what is important to notice here is that this actually also applies to what we call economic hedge. That means if an entity enters into a derivative in order to risk management, then the result of that derivative should also be allocated to one of the 3 categories, depending on the hedge item. In respect of the balance sheet, the exposure draft just suggests a few amendments. One is that goodwill should be presented separate from other intangible assets, and the reason is that the nature of goodwill seems to be quite different than other intangible assets. First of all, it's not a specific asset, it's more a residual calculation on business and combination. And then it's not amortized as most other intangible assets. And the other is presentation of associate and joint ventures within the balance sheet. That has also to be divided into those that are integrated and those that are not integrated. In the cash flow statement, we have also a few changes. The first one is the starting point when you present operating activities. If you apply the indirect method, the standard will require that you always start with the profit of operation. Today we see different approaches. Some start with the net result and others start with other subtotals within the income statement. And also in the cash flow statement, you need to divide cash flow from associate and joint ventures into those that are integrated and those that are not integrated. In the cash flow statement, we'll also remove the exposure will also remove another choice. Interest expense, income and expenses today can be included within operating activities. I think that's the most common way for such presentation. But you can also today allocate that to the three activities. For the future, it has to be allocated to activities from operation, investing activities, or financing activities. And then finally, I will talk a little about the new disclosure requirements. The first one is about unusual items. Unusual item has to be disclosed and explained in one single note to the financial statement. And unusual item is defined as income and expenses that has limited predictive value for the financial statement. That means if you do not expect an item of the same size or the same nature for the future, it would be considered an unusual item. It's important to notice here that remeasurements are not considered unusual items. This could be a significant impairment charge, or it could be a significant write-down of inventories. Besides explaining the nature of such item in the notes, it should also appear in which line in the income statement such item is included. Here you can see an illustration that show what it means about predictive value to the financial statement. The first line on the top, you have an item that is quite significant and of unusual nature this year, but you have something similar 2 years ago. But because you do not expect that for the future, it's considered an unusual item. In the line in the middle, you have an unusual and significant item this year, but you expect something similar for the 2 coming years, and for that reason it's not an unusual item. And at the bottom you can see an example where we had the item in the past, we have it this year, and we expect that for the future. Because it's much more significant than you would expect for the future, it's also considered an unusual item. And finally, a little bit about what ISB called management performance measures. We are used to see this as a kind of alternative performance measures or non-GAAP measures. How the ISB is defining management performance measures is whether the entity is using different measures than GAAP measures in their financial reporting. This could be in management commentary, but it could also be somewhere else in the public area, press release, investor presentations, and so on. And if the entity, the management, applies such measures, they have to be catched and included in one single note. And then they need to provide a number of information on such. We know that today the guidelines from ESMA have similar requirements. That means you need to present reconciliation of that item to the nearest IFRS measure. You need to explain why this provides a better view than the GAAP measure and some other disclosures. So that was all about the exposure graph for the new standard. And now I'll hand it over to Henrik Grønnegård, who's going to talk a little about of the SF.
Thank you, Søren. Now to something completely different, and yet perhaps with a link to the need for more comparable information of financial statement across companies being one of the primary drivers actually for the changes to IAS 1. SF, or the European Single Electronic Format, is the new electronic format that has to be used for annual reports for all listed companies in EU for 2020, including banks and other financial institutions. That is more than 5,000 companies across EU that will have to report their annual report for 2020 using this format. SF is the product of the European Securities and Market Authorities, also called ESMAs, that has developed a regulatory technical standard, also called an RTS, for preparation of an annual report that includes both a human readable layer and a digital layer that can be read by computers. The new reporting requirements applies to entities that has shares or debt instrument listed on a European regulated market. The current commonly used PDF format will not comply with the requirements in this ESMA mandate and have to be replaced by this new format for 2020. Both the human readable layer of the annual report as well as the digital layer will have to be audited by the company's auditor, and the auditor has to express an opinion on the digital layer as well in their auditor's opinion for 2020. What does this actually mean more precisely? Well, it means that all issuers will have to prepare their entire annual financial report in this format, in XHTML. It's difficult to pronounce and perhaps even more difficult to comply with the requirement, but it has to be prepared in XHTML format for 2020, the entire annual report. So what you today have in PDF will have to be converted into this format. The XHTML file can be opened and viewed using different sort of web browsers. It could be Google Chrome, it could be Microsoft Explorer, etc., and thereby be human readable. On top of that, if you have consolidated financial statements in your annual report, you will also have to tag the consolidated financial statement to XBRL. So you will have to tag the information from the consolidated financial statement to an XBRL taxonomy, making the annual report machine readable. So users of the annual report can take the entire inline XBRL document and analyze it and use it directly without the need for rekeying it into their systems for analyzing the annual report. There is a stepwise approach to the implementation of the XBRL tagging, meaning that for 2020 and for 2021, you will only have to tag the primary financial statements, the primary consolidated financial statement being the statement of comprehensive income, including profit and loss, balance sheet, the statement of changes in equity, and the cash flow statement. From 2022, the annual report for 2022, you will also have to XBRL tag the note disclosures of the financial statements. And therefore, when you decide which software tool you want to use for 2020 or which service provider you want to use, make sure that they can also handle the note disclosure requirements regarding the tagging in 2022, or at least be able to to change the tool or the the service provider in 2022. Talking about SF, there are some key terms that you should be aware of, at least when you talk to service providers or companies offering tools for handling this new requirement. The first one is the XHTML, which I already said is a file that can be read by browsers and thereby making it human readable. It will be kind of a website actually presenting your annual report. And that will be the format that will replace the PDF format going forward. Then there is XBRL, and that is a language, digital language that we have been used in Denmark now for a number of years. And now it actually also will be the requirement for listed companies all over Europe. What is new and different compared to what we have done in Denmark so far is that we now have to report in inline XBRL or using the IFRS technology, which is also called. And that actually combines the XHTML format with the XBRL language and thereby combine it into one file that will be both human readable through the web browsers, but it can also be read directly by computers through the XBRL tagging, and thereby making the distribution of financial information much more efficient than what we have seen today. Finally, we have the XBRL taxonomy, and this is an SF taxonomy that is being provided by ESMA. It is based on the IFRS taxonomy, so many of the elements in that taxonomy is something that we already are used to in Denmark in connection with the preparation of IFRS annual reports to be submitted to the Danish Business Authority. And that is sort of the reference that we have to make the financial reports comparable across all the different types of companies that will be submitting their annual report in this format. This is not solely a technical exercise. We will also have to change the processes that we have today regarding the preparation, the approval and submittal of the annual report. Today, as you can see here on the dark blue arrows, we usually prepare a PDF document with the annual report that is approved at the Board of Directors meeting and then published, including the auditor's report. And then once the general meeting is held and the annual report is approved, that PDF is converted to a specific XBRL document, and those two documents are filed with the Danish Business Authority. Looking at the new reporting requirements, the XBRL tagging and the preparation of the inline XBRL document has to be prepared before the approval by the Board of Directors. And actually the Board of Directors also has to sign off on the XBRL tagging that actually is made in the inline XBRL documents. And that means that we cannot wait until after the approval to have the XBRL tags included in the annual report. We have to do it before the Board of Directors approves the annual report. And that also means that because we as auditors have to make an opinion on the XBRL tagging included in the inline XBRL that will be part of our auditor's report, the auditor will also have to go through the XBRL tagging before actually the report is approved by the Board of Directors to make sure that the annual report can be published immediately after approval by the board. Once it is approved by the board, the complete set of files, being the XHTML file and the inline XBRL files, will have to be uploaded to to the Danish FSA, Finanstilsynet, immediately after it has been approved by the Board of Directors. So thereby also the XBRL tagging and the XBRL information will be published immediately after the board having approved the annual report. But still, we also have to report the annual report to the Danish Business Authority after the annual report is approved at the general meeting. And even though some of the XBRL tagging that has been included already, submitting it to the Danish FSA, you will have to supplement the tagging with some additional tagging according to a Danish Business Authority taxonomy, where some of the elements in the management's report, being the CSR statement and other statements and the auditor's report, have to be included in the file that is being sent to or submitted to the Danish Business Authority. So also when you choose a service provider or a tool, make sure that they can handle that the annual report is tagged to two different types of taxonomy, being the SF taxonomy and the taxonomy from the Danish Business Authority. What should you do now? Well, if you haven't already chosen a tool or service provider for preparation of the inline XBRL document, you should do so now. Identify at least 2 to 3 different tools or service providers and have them present their tool and services to you and see whether they match your need. Then pick one of them. We have in Denmark 2 to 3 companies that actually both have tools and also offer services that can help you with the conversion from the PDF document to the inline XBRL document. There's also a number of companies outside Denmark that can offer the same type of services. Secondly, have your 2019 annual report converted to the new format. So take the PDF form with your 2019 annual report, have it converted to XHTML and include XBRL tagging in the inline XBRL document, that is the XHTML document with the XBRL tags, and make sure that the layout and the tagging and also the process for preparing the annual report in this new format, it works for you. In that connection, also involve the auditor in that process to have the auditors sign off on the XBRL tagging that the auditors agree with that tagging. So it's not something that has to be discussed in January, February, where the final annual report is being prepared. As a third step, draw up the process leading to finalization and approval and submittal of the annual report, including deadlines for the main deliveries, and make sure to have enough space in that time process to have the Board of Directors approval, the auditors audits of the XBRL tags included in that process. That will be new compared to what you have done so far, and therefore make sure that there's enough time for these additional tasks to be made. Once you have drawn up that process, have the audit committee presented to the audit committee and have their approval, sign off on that process, and also the internal controls included therein. It is the responsibility of the Board of Directors to make sure that the annual report is correct, and that includes the XBRL tagging also going forward. Looking ahead, make sure to have any long-term impacts of the requirements included in the need for the XBRL tagging. That is the note disclosures, that the tool or the service provider that you choose can handle this. Also be aware of that with more than 5,000 companies that are preparing the annual report in this format, there will be much more attention on the XBRL data that we have been used to here in Denmark so far. You will receive questions, comments, etc. that you should be ready for answering after this new requirements is implemented. That is what I had on the SF requirements. If you have any questions or want a more thorough discussion on the impact of the SF requirements, please reach out to us and we will be happy to attend a meeting. And now I will hand it over to you, Martin, for an even more exciting topic.
I would like to welcome you to this special interview on investors' perspective on ESG reporting. We're living in times of change, impacted by Corona, crisis in certain sectors, growth in others, economic recession, uncertainty for all, but also climate change and climate risk that we need to address as a society, focusing on the SDGs and developing new strategies for change. A lot of change is also happening in ESG reporting, and we all see that efforts needs to come together through the same journey to achieve consistency and comparable information. At Deloitte, we advise our clients on sustainable strategies through the lens of change in order to achieve sustainable impacts, measurements and reporting. I'm very excited to welcome here our special guest, Anders Schelde, is the Chief Investment Officer at Academiker Pension, formerly known as MP Pension. Together with his team, he manages a portfolio of 130 billion Danish kroner. 8 billion Danish kroner of those are invested into Danish listed companies. In recent years, Academiker Pension has also focused on themes like sustainability, responsible investments, being a more active investor, but also themes like diversity and remuneration and climate risk. So Anders, the first question for you is really, why should companies step up in this game of ESG reporting for investors at the moment?
They should focus on this because we can and we must. And by that I mean that over the last many years, our ability to collect and process data has grown exponentially. So today we can actually monitor our businesses in many more ways than we could just a few years ago. And we must do so. We must do so because as a society we face enormous challenges, not least the climate crisis. So we need those data in order to steer clear of those challenges.
Yeah. So what are the different challenges that you face as Academiker Pension and that you envision that other investors are facing in terms of gathering and comparing these ESG data?
I think what we hear from many of the companies that we invest in is that it's actually a huge task for them, a huge challenge for them to collect all these data points and provide all this information in various reports. And I would say we have the same challenge because what we do is actually an aggregation of what all our companies in the portfolio do. And so it's something that we all struggle with, I think, and as you also alluded to, we need more standards, and hopefully they are coming, but things are moving so fast in this area that regulation and legislation will always be behind, and we cannot wait for that. So we just have to manage through this, I would say, almost rather chaotic period, and still be ambitious and do as best we can to collect these types of data.
So we need to manage the change process together, so to speak, as a community of investors and companies and advisors and other stakeholders in order to achieve the objectives of change and a more sustainable world, so to speak. Yeah, true. So which recommendations do you have for the audience today in terms of being a listed company in Denmark? What should they do in terms of ESG reporting, reporting on climate change, risks, for the upcoming annual report here in 2020?
Well, for a number of years, we have put a specific focus on a few topics, as you also mentioned, in regard to Danish companies. First of all, I would like to say that practically all Danish companies are very well run, are very well sort of on top of the risks in their business. But nevertheless, we do see a few things that sort of cut through many of the companies that we invest in. And these areas have to do with diversity, both in management, but also all the way through down the organizations. So that's something we focused on. We also focused quite a bit on remuneration, and particularly, of course, for top management. And then lastly, climate data. I think that is probably the most important one, because this is the most acute and the biggest challenge that we do have. So that's something we're going to keep pushing for. We've been asking in our dialogues with the companies and our formal letters to the boards for companies to sign up to the TCFD framework. But still very few companies have done so far. So we're going to continue to push for that. And I think we're very likely actually to bring it into the AGMs as actual shareholder proposals from our side.
That sounds good, because I think that's some of the developments that we need to see in order to make progress on this journey, to have some standardized reporting on climate risk and how it impacts the company and how it impacts financial reporting, so we get it into financial measures. Any final recommendations for companies aside from addressing climate risk reporting?
Yeah, certainly that's one issue. Another thing that's also in our focus is tax reporting. I think most companies do quite well in terms of having formulated a tax policy, but we think we still need more tax transparency. And in particular, we think that it would be very useful if more companies, not just Ørsted, as the only company in C25 index, if more companies followed their example and actually provided country-by-country tax reporting. We know there are a lot of concerns out there in regard to this, that it might be too much transparency, but in our view, it's something that you can actually manage. I would just say, take a look at what Ørsted are doing.
Okay. Thank you, Anders, so much. Thank you.
You're welcome.
Climate change and impacts on financial statements. That's the topic of today. Investors are concerned that companies in general are not disclosing enough and detailed information about the impacts of climate change on the company, its strategies, and also its resulting financial statements. So there's a course for handling these challenges and doing more than we've done before. So what we believe is that companies should address these climate changes, of course, but also report transparently about the status and the processes to date in that respect. We recommend that companies use the Task Force on Climate-Related Disclosures framework, the TCFD disclosure framework that also investors recommend. And we've seen that when we prepared our climate change newsletter here in July of 2020, where we see good examples of companies reporting using that exact framework, especially from the UK, but we also seen good companies in Denmark reporting under that framework. So there's no reason why not to use this framework right now. It includes some core elements that clarifies how the company is impacted by climate change. It includes governance, so how boards are overseeing these risks and how management is managing and addressing the challenges seen. It includes also risk management and strategy and how the company really manages processes for identifying and responding to risks, and also how those processes are really integrated into the enterprise risk management of the company. Further, there's recommendations about metrics and targets, so disclosing which metrics are the most important to your companies and also which targets you set going forward. And especially on climate and emissions, there are recommendations to disclose both Scope 1, the direct effects, and Scope 2, the indirect effects of climate change and greenhouse gas emissions of the company. So here for 2020, we see that companies need to address this also in the management review section of the annual reports, where there's now new requirements under the Danish Financial Statements Act for large companies in reporting class C and D, the listed companies, to disclose further on the principal risk and uncertainties, including climate change and impacts on the financial statements. So climate change is clearly impacting financial statements, as we can see here on the slide. The next slide is highlighting those impacts. exactly as I said, on the company, on the management review, but also on the account balances like impairment testing and provisions and contingencies. So there's a lot of examples where climate change might impact the assumptions and key uncertainties disclosed in the financial statements. So if we turn to ESG reporting, which is a part of the same story, so to speak, there's no reason why not to use these frameworks, because it is established good frameworks. A lot of guidance is out there. A lot of stakeholders are reporting recommendations and regulations. New developments will happen from the EU and the Danish government. However, NASDAQ and FSR has already pushed out guides for consistent reporting. The definitions are there. They might change a bit, but they're still there and they're good enough to be used. 30 metrics from NASDAQ and 15 prioritized metrics from FSR and NASDAQ combined. So please start using those and communicating clearly on these. And there's clear guidance from the authorities also in that respect. Obviously, reporting on ESG measures is part of a larger story. It is about also taking it in, adopting it in your companies, within the strategies to align ESG measures into the overall core strategy of the business. It is also to assign new and more resources to the processes in order to be able to manage and measure the impacts of those ESG metrics that are the most important to you, and then obviously follow up on that and communicate and engage the wider population of stakeholders. And then a final fifth recommendation, that is to involve your audit committees as they are appropriately fit for purpose in terms of addressing these reporting needs of the investors and to oversee these new disclosures. Even though they might not be experts in these type of non-financial informations, they are certainly well equipped to oversee the quality and the assurance also by auditors of such metrics in order to avoid any greenwashing. They are also well equipped to ask probing questions and set new ambitions in this area. If we turn to a separate topic of the ESG measures, it's remuneration reporting, where there's new law coming into force here in 2020 for those calendar year reporters. So all listed companies in Denmark having listed shares are obliged to report a new remuneration report. And here it is, for the first time, I guess, mandatory to apply the new law. And of course, it requires a different kind of effort than we've done before when it was only voluntary. So at Deloitte, we're ready to advise you and guide you along the way, not only on remuneration reporting, but also on remuneration strategy, design, remuneration committee work, communication and implementation. But turning the focus really here today on remuneration reporting, here on this slide we highlight some of the key elements of the new requirements that are due to be planned, incorporated into your remuneration reports for 2020. We've seen some good and comprehensive examples from Novo Nordisk, from Ørsted and from Vestas, but none of these companies are really reporting under the law requirements for 2020. We've only so far seen Chemometic reporting the 2019-2020 here in mid-September, and their remuneration report was in compliance with the new law. It's also important here to highlight that the Danish business authorities are recommending to use the granted pay as primary reporting when you have share options, when you have shares reporting in long-term incentive schemes. And that is for the single figure table, the most important figure where you disclose the individual CEO and other executive members' remuneration in total. So those definitions really matters quite a lot. And it is important to emphasize that 23 companies of the large cap companies in 2019 did actually use expense pay. And that is, in our opinion, not allowed going forward. In 2020, you need to either apply the granted pay method or the vested pay method. It needs to be aligned with your remuneration policy. So whatever you stated there in your remuneration policy, that needs to be consistently reporting in your remuneration reports for 2020. So there's appetite, obviously, for change here. And I know that the Danish business authorities are also working on updating their guidance in this respect to make it absolutely clear. And that guidance is being updated as we speak. We also see that boards need to involve them, or you need to involve your boards in making sure that you get the proper level of assurance on your remuneration reports from your auditors to add value to shareholders. We see these 5 different levels of assurance, really ranging from no assurance to almost, you could say, full assurance with audit of certain numbers. Under the Danish Companies Act, companies are required obviously to report remuneration report in accordance with paragraph 139 B, section 3, and there are 6 items within there. And the auditors are then obliged to check that these disclosure requirements are fulfilled in the remuneration reports. And if they're not, they are actually required to report to the annual general meeting that these requirements are not fulfilled. So in addressing this, we believe that the auditors should do a report. It should be a report of reasonable assurance. So it's really level 2 here, saying reasonable assurance that management has complied with the law, so to speak, in the Companies Act, this paragraph 139b, section 3. And that is really all we're required to do. We're not required to look at the numbers if the remuneration report is reported separately. If the remuneration report is integrated into the management review section of the annual report by way of a link or in a summary, or so to speak, then we would need to comply as auditors a consistency check to validate that the remuneration report, the disclosures, the numbers, the descriptions of the long-term incentive schemes are consistent with our knowledge from the audit, and it also ensures that it's complete. And then if you aim for a higher level of assurance, you can also get limited assurance on the whole remuneration report, that the quality of the processes surrounding it, that the numbers are consistent, that they are reported consistently against the reporting practice that I mentioned, against granted pay, and the definitions and the calculations are, so to speak, tested. Maybe not on an audit basis. When you provide limited assurance, you only do it on a very, you could say, more random basis, test the controls and the procedures, whereas when you get to the 5th level, you do test also the surrounding controls, but also do the testing of the details of the calculations for all the numbers tested when you do an audit. And then finally, on the new recommendations on corporate governance, there are new recommendations set up in draft here from the Danish Committee on Good Corporate Governance. There are some significant proposed changes here. They are due to be effective for 2021, so you have another year to prepare for these, but they are quite significant. There are some new elements around sustainability, diversity, purpose, and also further transparency on tax and diversity policies, including also an even more focus on the value of board evaluations and management evaluations. So certainly some key elements here to work on also going forward in 2021. Thank you.
Thank you, Martin. And now on to IFRS in focus. And as said at the beginning, for this year, we have chosen the topic COVID-19. I know from a fact that maybe all of you, or at least the main part of you, have discussed COVID-19 impacts on your financial statement with numerous external advisors, auditors as well. The highlights we have chosen for this IFRS update are maybe not, at least the most obvious ones, impacts on your financial statements. At least it's the ones that we have experienced being the one that are a bit surprising when we talk to you or some other entities about it. The first one chosen is valuation of inventory and divided into 3 items: write down because of obsolescence, impact on net realizable value, and overhead costs. If we start with write down of obsolescence, for example, if you have seasonal goods, these seasonal goods are impacted by COVID-19, you will have more slow moving stocks on your inventory than expected, and therefore it could give rise to at least consider if you should write down your inventory. Net realizable value are impacted by two elements. It's impacted by your selling costs, and for example, COVID-19 could impact your selling cost. But it's also impacting your selling prices. And your selling prices will also maybe be reduced because of COVID-19. And the last but not least, overhead fixed cost. Overhead fixed cost, at least what I've seen, is that you do a calculation based on your total fixed cost divided by a normal production facility. Your normal production facility will in COVID-19 times maybe be considered as abnormal. And if you then still divide by that abnormal production capacity and simply just allocate a higher cost to each produced item, that will be wrong. So you have to have an unallocated fixed cost that should be booked directly to your profit and loss. Next thing coming up is impact from COVID-19 on your expected credit losses on trade receivables. 4 items we have chosen here to consider. One is your historical experience. As most of you have calculated your expected credit losses based on historical experience, that historical experience might be based on market conditions that are different from the market conditions that we actually see today. Therefore, a different risk picture, and therefore you have to adjust that historical experience to your current market condition. So your expected credit loss calculations are not based on a wrong historical experience, or at least a historical experience that doesn't consider the market conditions you have today. Another part is uncertainty. COVID-19 definitely gives uncertainty into the markets right now. That uncertainty point into risk. Risk point into that you have to consider if your expected credit loss consideration should be adjusted, taking that risk into consideration. Third item to consider is portfolio approach. Pretty sure that all of you, or at least the main part of you, do your expected credit loss considerations based on a portfolio approach. You might also have some subgroups in that portfolio approach today. The risk picture on your trade receivables might be different in a COVID-19 situation, and therefore it might give rise for you to consider if you should do more subgroups or if you should exclude more individual debtors from your portfolio approach. And then default. Some of you have realized or will realize in the future some more default on some specific debtors because of the pandemic. These default on these specific debtors will of course impact these specific debtors, but it will also give rise to a consideration for you if you should determine a more broader default picture on your total trade receivables. On this slide, we have highlighted what we see as the most reasonable impacts from COVID-19. 2 of them have been pointed at. One of them is share-based payment programs. If you cease operation or at least realize a reduced activity in operation, that might impact the vesting conditions in your share-based payment programs, impacting the recognition and measurement of your share-based payment programs. And then the last thing I'll mention today is YES 20 about government grants. I don't know about you, but at least from my point of view, I have not studied YES 20 for the last couple of years. I have for the last couple of months. Government grants are being very actual in the world we see right now. We have different aid packages in different countries, both in Denmark and abroad, and you have to consider these aid packages according to the rules in YES 20 about government grants. Then over to you, Jan Peter, about trends.
Thank you, Bjarne. Yes, we have looked at the annual reports for 2019 and picked out some of the trends that we see, and they are listed here on this slide and on the next slide. I think I can start by saying in general, we don't see very big revolution in the 2019 reports, and that is simply due to the fact that the Danish companies, they have been very keen on improving the annual report every year, and therefore it's now getting more and more difficult to actually find out what can you do to even improve further. But there are good efforts still being done to improve especially the management report, to secure there's more coherence between the front end and the back end of the report, and also how you can further improve transparency in the annual report. So if we just look at some of the trends that are listed on the slide here, the use of ESG measures is coming into the annual reports. It is, for instance, some of the companies, they have started to put some ESG numbers into the 5-year figures. So you have both the financial figures and also some of the non-financial figures. And that is, for instance, an example from DFDS, where you can see such a development. The second trend is, of course, the remuneration report, and Martin has already talked about that. So I will just here say that if you would like to see some examples for inspiration, and without saying that those are complying fully with all the rules, but here are some of the companies that have already worked with this. I will mention Ambu and I will mention Carlsberg. I think Carlsberg is in the situation that they have some international board members from the UK on board, so they have been used to actually providing this report already and drawing on that experience. What we also see is that more and more companies are trying to pull out what you would call more static information from the annual report, the printed annual report, and put it on the website. So for instance, if you have your strategy and you have outlined that in a document, then you don't need to repeat that. What is the whole strategy about? You don't need to repeat that in the written document, but you can refer to the document on the website. And then in the printed report, you can simply say what has been the activities during the year to follow that strategy. Another good example is that because of the volume of the annual reports are getting more and more, companies are trying in general to put these separate reports like a CSR report and gender report on the website. And to make sure that the reader is aware of that, if the reader is sitting with the printed annual report, there's a good example in the annual report of ESS, where they, in the first page on the table of contents, they have put there at the bottom saying that these 3 supplementary reports, they are put on the website. So the reader will already know from start that you don't find anything about the CSR in the annual report, or maybe just a few words, but not the full report. You have to go to the website to see that. And that is a way to try and reduce the number of pages that has an event of just growing as we speak there. I think also what you can see from trends is by looking at some of the survey, what are the investors, what they would like to know. And I have here a report from the UK Accounting Lab. They have asked the investors, what are you interested in hearing when companies are reporting in times of COVID? And both in the short and in the longer run, liquidity is by far the most important topic that the investors would like to hear about. Then if you are moving a bit away from the very short term, from 3 months to 6 months, it is still liquidity, but they would also like to hear what are your recovery plans out of the COVID-19 pandemic. And if you move further ahead into the longer 9 to 18 months, then you actually have 4 topics which are equally divided by or around 20% each, is operation, strategy, liquidity, and recovery. So you should be aware that many of the investors, they seem to focus quite short term. So it's important to have the information on the short term, but at the same time also keep an eye on what they would like to hear for the longer term. Of other things that I think will be part of the trends for the coming year is to look at the criteria for the annual awards prize that will be next year in September, the 2nd of September 2021, where they have just issued the criteria now. And they will, of course, be looking at climate, which is a very hot topic, I think, everywhere in the world. And also expectation for the future and how have the company come across the whole area of COVID-19. How has it impacted the business, and has it made any changes to the business model because of constraints in how they could operate under the current business model? So these are some of the trends that I expect to see in the next round of annual reports. And if you like to position yourself as a candidate for the annual reward prize, I suggest that you look at the webpage of either Danish Confederation of Industry or the Danish Auditors, FSR, where you can see the criteria for the annual award prize 2021.
Thank you very much, Jan Peter. And I guess the time is up, but we have some interesting questions, very short ones, that we also want to answer before rounding off. So taking the liberty to use a couple of minutes of your time this morning. I've brought Henrik and Søren with me in this cozy couch, I would say, because the questions are related to the items that you just presented. Mm-hmm. And Søren, will you start about the exposure draft?
Yes, of course. Yeah. And the first one is about the presentation of unusual items. And the question is whether this is just applied to the operating category. The standard is not saying anything about that. It's just referring to income and expenses on unusual nature. So we assume that it's applied to all three categories. That means operating category, investing category, and financing category. It's important to keep in mind that you had to, in the note, to specify what line item in the income statement the item is included, and by that you can see whether it's one of the other of the three categories. And furthermore, it's also important to keep in mind that this does not apply to remeasurements, and maybe often we'll see remeasurements included under financial items or investing items.
Great, thank you, sir. And Henrik, I have two short questions related to the ESEF requirements.
The first one is whether the SF mandate also is a requirement for company listed on First North, and the answer to that is it's not. It is only companies that has debt instruments or shares listed on regulated markets covered by the EU transparency directive that is covered by the ESMA requirement and the SF reporting. So it's not First North. And the other question is whether also figures in text paragraphs in the annual report has to be XBRL tagged. And the answer to that is also no. It is not amounts in text that should be XBRL tagged. It is only the primary financial statements in the consolidated financial statement that has to be XBRL tagged. So it's a comprehensive income, balance sheet, cash flow statement, and statement of changes in equity. So not a requirement for tagging amounts in text paragraphs. From 2022, the notes should be tagged as well, the notes to the consolidated financial statement. But that will be what is called block tagging. So it's not specific amounts in the note that has to be tagged. It's only the notes for instance, tangible fixed assets. It's a complete note for that has to be one tag. So it's not the specific amounts in the notes that should be tagged.
Great. Thank you both. We have more questions, and as promised in the beginning, we will answer all questions to the specific person that asked the question after this session. And you will also have the slides sending. So I guess that's all for now. Thank you very much for joining, and hope you found it interesting. And on behalf of the full team in here in the TV studio, thank you very much for your participation.